Welcome back to this financial podcast. I want to discuss the previous position that I was in, and that was AT&T. I've exited that position a while ago, so if anyone is still in that position, you could decide where you want to get out based on if you have other strategies that you're using, but that position has been exited a while ago, and it was a really nice profit. It moved nicely for us, and I'm going to be looking at that stock again, probably in the near future. Okay, so now I'm going to be talking about something that I haven't spoken about in past financial podcasts, and that's options. Now, for those of you that don't know about options or don't know what options are and you find it difficult to understand, just sit back, relax, because I'm really going to explain it. It's pretty simple. There's a right but not an obligation to purchase or sell a stock at an agreed price and date. Now, you don't even have to know what options really are to use this strategy. So that's what makes this strategy so beautiful. You don't have to really worry about how to figure it out, what it is, and it really doesn't matter because this is going the other way. We're selling an option here. So it's basically similar to selling a stock short. You're making money when the value of it goes down. So it's the same thing here. And again, if you don't know about options, don't worry about it because I'm going to show you the mechanics of this trade, and that's the main thing. The main thing is the mechanics, how it works, what you're going to be doing, and how to make money. So right over here, I have what you call a option chain. Now, to find option prices, you need to have an option chain. This is just one website that has them. Many financial websites have the option chain. This particular one is NASDAQ. And right over here, I have an option chain for Qualcomm. Now, this is a stock that I've invested in the past. The beauty of this investment is that it's totally risk-free. If you plan on buying Qualcomm, let's say you plan on buying it anyway. Now, of course, buying the stock is risky. Buying any stock is risky, but the risk-free part is when you already plan on buying it after the fact that you took the risk. See, that's the beauty of this. Because once you decide to buy it, I'm going to show you how to make money anyway. And I'm going to show you something even better. I'm going to show you how to make money even if you don't buy the stock. And it's going to be risk-free. Now, this strategy is going to be called selling cash secured puts. So a put option means you expect the price to go down. But when you sell an option, you want it to do the opposite because you want the option to lose value. You want the premium to lose value. The premium is what you pay for the option. So you want the price to actually go up. You don't want it to go down. Because if it goes up, the put option is supposed to do the opposite. It goes down. Remember, you're selling the option, you're shorting the option. Okay, so the price for Qualcomm right now is $57.46. Now, let's say you don't want to pay $57.46. Let's say you want to pay $57. So, you can sell an option at $57 rather than place a limit order just to buy Qualcomm at $57. You can sell one put option at $57. Now that will be the strike price. That's what it's called when you select the price for the option. It's called a strike price. So you want to get at 57, so you select a strike price of $57. The expiration is right here. This is when the option expires, so that will be April 12, 2019. And right here is the last price of the premium. That's the price you would pay for the option. However, we're selling an option now, so this is the price you will receive for the option, and that will be $153. So this $153, as soon as you sell this option, you immediately get $153 in your account. Now you can't keep the money. You have to wait till this option expires or you decide to buy it back. It basically just means that you could offset the option. You liquidate it. If you buy it back, it's just like buying back a stock that you shorted. So it's the same thing. However, if you want to get the full amount, and when it goes to zero is when it expires. So it's going to expire in around 23 days. So in 23 days, this premium income will be yours to keep, regardless of where the stock goes. So if it hits $57, you're going to have 100 shares of Qualcomm. That's right. Every option is 100 shares. One option equals 100 shares. That's the way it works with stock options. So if it hits 57, you get 100 shares and you still keep this money. When this option expires, In this case, on April 12th, you keep the $153, and you also long Qualcomm at 57. Let's say the stock doesn't go to 57. Let's say it goes to 58, 59. Well, guess what? You still make money. That's right. You're still going to collect $153 when this expires because you sold the option. So if it goes up, which is really what you want the stock to do if you're just looking to make money and not hold the shares of Qualcomm, because you sold the put. So if it goes up, that's what you want it to do. You don't get the shares, but you still keep the $153. Now let's say it hits 57, you long the shares, right? And you collect the premium when it expires. You can always sell the stock. Let's say it's at 57 and it's bouncing around, doesn't go anywhere, or it's flat. Let's say you decide not to hold the stock that you have to buy, because once it hits 57, the option is exercised and you automatically get the shares. That's the way this works. You can always sell the stock and you still keep the premium income. So that's the beauty of this trade. And you can repeat this over and over again, and it's a great way to make some extra income. So the mechanics of how this works is simple. You just go to your brokerage account, you go to where it says options, and you just put in the month, you put in the stock that you want to trade the option on, which is Qualcomm in this case. It could be any stock. And then you can also decide where you want to get filled. So you can place a limit order. Let's say you want 153. Of course, you want the premium to be higher because you make more money the higher the premium. So you could set it at 153. You could set it at 154, whatever you want. Or you could just sell it at the market. I generally like to do a limit order. So if it's at 153, the best chance of getting filled would be at 153 or better. So you can do it like that as well. And that's it. Set it and forget it. You wait till you're filled. Once you are filled, the premium income goes into your account, and then you just have to wait and see what happens. Whichever way the stock goes, you're going to make money either way. So there you go. That's how to make money selling a cash secured put option. There are many strategies how to trade options. This is just one of them. What do you think about options? Is this something you have invested in before, something you might be interested in the future? Please leave some comments and let me know. So I hope you found this video useful. If you have, please show your support for this channel by subscribing. Feel free to leave comments. Please like up this video, and thank you for tuning in.